Welcome. This is the January 7th episode of the Trading Pit, where we break down the Bitcoin and crypto markets with human and AI insights. It's the first show of 2025, and I think it's going to get spicy as these markets look to rock and roll. I am your host, Marconi White, and in part one today, I'm joined by Benjamin, the whale hunter, and Amit, the range sniper, who are going to answer got that one wrong. How strong is Bitcoin and the rest of the market during the first week of 2025? In part two, Ben Lilly will be back with his latest issue of the Flow Report, and he's answering a hot button topic. Is Athena to blame for Ethereum's terrible price performance in the first 12 months, or the last 12 months, actually? Pretty much all of 2024, it's been a lame duck. But first, it's rapid fire. I'm looking for some hot takes on complex questions from two gentlemen who haven't had sleep since 2024. You guys ready?
Yes.
Let's go.
Oh, all right. They got more enthusiasm. Maybe they got something in their coffee. All right. I'm going to go. Both you guys are going to answer both these questions. Let's see. All right. Let's start off with you, Benjamin. Bitcoin or L1s for the win in January?
I think it's Bitcoin.
You think it's Bitcoin? By amount?
Yeah.
You agree?
Bitcoin.
You guys agree? You're all in accordance here?
Yeah.
Yep.
Okay.
Yeah.
Okay.
We drank the same Kool-Aid.
You got to get something to keep you going in the mornings when you're not sleeping. Ahmed, anything to add to that? Anything from your, we already passed your prediction for 2025, so you got to be feeling good about that.
And that was the start of prediction. So basically that was where I wanted to be, so that I can start the year on a high. So that's a good thing to start with. Now, market is looking healthy, market is looking good, nothing changed. So happy for that.
All right. And for all those asking, yes, Amit got a new microphone. It's something you can get at a gas station somewhere. We really wanted to downgrade his audio because he was sharing too much alpha on every show. No, we're gonna get that. We're gonna get that fixed sooner rather than later. All right. Next question: L1 alt season, Ethereum or Solana capturing just the greatest gains? Which one?
Solana, hands down.
Yeah, I agree too. It's Solana.
Solana for the win. Oh man, I wish Ben was here. He could put up a fight, but I've got nothing to say. I think my Solana bag's a little bit bigger. Why? Any thoughts to provide there? Anything to share?
It's just the activity on the network.
Yeah, it's still the development, activity.
Oh.
The number of developers who are constantly building something. So.
Okay. All right. So it looks like then that's a pretty simple take. Solana for the win. All right. Alt season, double top in 2025 or single run? Which is it?
I think we'll get a run.
A single run or a double top?
I don't think
it's a double top.
I think we'll get a dip. We'll get a solid correction in.
Okay. So that
correction, I agree. We may get a correction, sure, but I don't think this is a double top for the year. I don't think we have topped out.
No, not by any stretch. Yeah, alts are going to run.
Okay. All right. So alts are going to run. It's a single top. We're going to see a crazy run, but we're obviously not there yet. All right. Last question, not crypto related. 2025 resolutions. What did you guys commit to for 2025 to be better versions of yourself? Start with you, Amit.
Get healthy and trade more.
Get healthy and trade more. Those seems like those are polar opposites. You can do one or the other.
Exactly.
Your wife's already drafting up the divorce papers, depending on which one you land on. All right.
No, I'm already out of the house, so I work from the garage. So.
Oh, okay.
No problem there. She can keep the house. I'm happy in the garage.
Okay, so you're on your way out. All right. Well, that's a healthy way to start the year. Living in a garage, hopefully on a nice bench. All right, Benjamin, what about you? What's the resolution to be the better version of yourself this year?
Sleep more than 4 hours a day.
That's what's happening. I can tell you now.
So he's committing to something that's clearly impossible.
Ask him, has it happened yet? I mean, resolution is one thing. Has it happened yet?
No.
There you go.
Okay, so maybe what you should say is sleep more than 3.5 hours, and you'll already hit your mark.
There you go. Yeah, just like BTC hitting 100K from 99.
Yeah, that's right. Really lower the bar.
Exactly.
Oh man. All right. Well, let's get into the price action. I think you guys have some interesting resolutions. I'm hoping some of them come true. I'm not sure exactly why. For everyone out there, we'd love to hear what you're doing in 2025. Make a better version of yourself, either in the crypto world, or personal life, or whatever that may be. Let us know in the comments. But let's get started looking at some of the data here. Very interesting start to the week. I would say I'm going to start off looking at the ETF flows, which were just monstrous for Bitcoin and Ethereum. I calculated up here. Bitcoin started, I think, the first day down 242 million, and then 2 days where it almost hit a billion both times, coming at 1.6 billion just at the start of the year. And Ethereum not doing too shabby either. It had 1 day where it was down 77 million, but after that, 2 solid days, coming in at 110 million to start. But coming back to Bitcoin, if I look at the numbers here, just over the last 7 days, it's up 5%. It's trading back in the 6-figure range. Guys, what are we looking at here? I think we were talking offline about this kind of being in a sandwich pattern, maybe expecting some consolidation. We talked about last week, kind of in the 92 to 98 range. Has it broken out there convincingly? Are we seeing enough from the Coinbase premium to say, buyers are back? What are we looking at here? Benjamin, you got something to share from Panda?
Yeah, yesterday I think we saw some good Coinbase premium. And as you see in the chart that I'm sharing, it was the volume web zone near the 98K area. And I was actually thinking that we'll just test it as resistance and get back to 93K. To be honest, I did not expect a move up yesterday. Given that, I was quite glad that we saw a move up as well, even though it seems a little weak. There was a lot of FOMO from the open interest side as well. So I'm pretty sure a lot of futures traders were chasing it because a lot of them probably were also back at desk after multiple weeks of holidays. And you see a green candle going into 100K, they didn't want to miss it. So I'm of the belief that we chop a little bit further. I think we probably will not break 98K, but I think we do chop a bit further.
So yeah. I want to comment on something. You said that this wasn't the most convincing kind of breakout above that line.
No, I mean, it was a good breakout. The reason is there was a Coinbase premium. Mm-hmm. So I'm of the belief that yesterday definitely a lot of spot buying happened. It did happen, but we also saw some massive chasing on future side, unidirectional chasing, I would say. And today we are immediately seeing a lot of that unwind, right? So when you have this type of Monday action, and on Tuesday, you basically have no bandwidth to run at all. And the moment Tuesday opened, it's just red, right? It's been that way today. In times of these type of price actions, it's just better to just wait. Let it come back to Monday low, see how price is reacting. The good thing is we are above 98K, which is very good, right? Yeah. And if we lose 98K, then we have to basically, assess a lot of things because structurally, 98K is a very important zone. Remaining above it is very important. If we close on a daily above 102K, I think it's solid and we can expect a much higher prices. And since we did not get that type of a close yesterday night or even today, I don't think we get. I think we have to just trade with a little bit of patience than even caution. So it's like if somebody is taking up some positions over here, and as long as you don't get liquidated at 92K, I think you're fine. But that being said, I don't think anyone has to FOMO here.
Yeah. Okay. Well, that's I guess that's kind of good to hear. How did Jay perform during this? I mean, did it kind of anticipate this movement was going to happen? I think we were expecting a little bit more of that consolidation.
No, to be honest, I did not anticipate this movement. When price went into 100K, basically it cut all its positions and went flat, and it's still flat. I think I've not checked the accounts today, but I think it's still flat. Nevertheless, this is still coming up in our chop zone. In most our metrics, it doesn't show up as a trending situation. It still shows up as a choppy situation. So because the whole action was about Monday, it was about the yearly open activity. The good thing is this also, puts in a very important level for us. Overall, this year, if we have to basically watch the 93K level, below 93K level, I think we are in trouble. We can go down all the way to 82K, even lower. As long as we continue to remain on above 93K level, structurally speaking, I think we are good. So
I want to ask, coming back to Jay, have you seen times where Jay has done this and we've really seen the market get ahead of itself? Maybe in this case, if I just use where we are, we're kind of sitting over a 6-figure, maybe it runs up a little bit further before retracing. And that's where Jay's able to get some good bids because all the risk metrics said, hey, just wait for a better time to get an entry.
Yes. So it's happened before that, right into resistance as it gets out of the positions because it sees some type of wallet class that is starting to sell. Or trader class, like the 1M to 10M size traders, if they start to sell, it basically gets out of position at that spot, and then waits until a better opportunity comes in. This is one of those situations. So we basically saw an overshoot all the way. It went up like 2K additionally compared to where it got out, which is fine. Risk management always triumphs. It's flat right now, and when there is another opportunity, it will start entering back into trades.
Yeah, very
interesting. See some tokens like Ethereum and Solana have already retraced most of their Monday move. And this is the type of situations which is very tricky because yesterday was so good and green, and today basically everybody is aping into everything. I see in my friend groups and everybody is talking about tokens that I've never heard in my life. And those are all red today because yesterday they saw it go bazinga, and today it's all retracing the whole move. So it's a mixed sentiment.
If only they were using an AI trader that had good risk management to manage that FOMO, maybe they wouldn't have to worry about buying into tokens that are about to sink 10, 15%. Just an idea.
That's just a whole point, to be honest. Sure, you can take 1% losses, 2% losses, even 3-4% losses. To be honest, on an account level, let's say you're taking a 10-15% drawdown, it's still not surprising because structurally speaking, even if you go for traditional finance assets, you will see situations where you take a 10-15% drawdown. So on an overall perspective, I'm saying, I'm not talking on a per trade basis, I'm talking on a full portfolio basis. So people who have the appetite to basically digest a 10% drawdown, I think typically if you are in crypto, you are accustomed to like even 50% drawdowns, right? Because if not, then you definitely have not made the generational wealth. You're someone of a tourist. So that's always my opinion. And you see a 15% red candle on BTC and you start panicking, then something is wrong with you. The beauty of we keep talking about the agentic infrastructure and all these things, and it's just an additional fancy name for what we are already doing over here with AI. Okay, you can call it already as an AI agent model. We just haven't thrown a chat window for our guys to sit and chat with, and that's coming soon. We'll bring it out. We're just busy on building much more cooler things than the ridiculous things that you see on Twitter. But that being said, risk management, often the biggest issue is you either hard code it or you basically go based on emotion, but you don't have a middle ground otherwise, right? But different situations go into a different type of risk management requirement. And in terms of red candles is when it gets really harder. And, as humans, you tend to make mistakes. But when you have an agentic structure, which has, gone through a lot of the risk situations and adjust itself in exposure, then basically this does well in long term. That's the whole point. Everybody thinks that the objective is about making 500% in a year or something like that. I always stick with the perspective that you got to build things which basically last longer, even if it makes lesser. So if it can make less, but be consistent and, work longer over an annualized basis, if it does better than what Medellin Fund does, then you are already beating the global markets. You're beating S&P 500, right?
Wealth.
And
Yeah.
for some, you're building wealth.
Yeah.
I look at it in that perspective.
Sure. Yeah. It's
and
like
this is where JAI and the additional models that we are building, the data infrastructure that we're building, all these things comes handy. Is it all perfect? Absolutely not. Have we not spent time on improving the prediction engines and the execution engines for the past 8 years? Absolutely. We have to keep always improving. There's a new release every month that we keep pushing. We don't announce everything because we don't have the time to explain everything to everyone.
Sure.
So probably often that humility comes at a cost because people think nothing is happening in terms of development. But a lot of work goes on a daily basis. I think sooner or later, this will be the only way to go. You just have AIs basically trading. At the very least, premium people will end up with that. And the normal retail, the $10 retail is probably going to be the ones who are your counterparties.
Yeah,
Well,
somebody has to.
I was going to say, Amit, jump in here. I want to hear your thoughts on sort of this risk management lens.
I was about to come on the agentic side because if everybody's using the agents, right, who's going to cross the spread? So you need the retail. You need retail for that, so that they can cross that spread and start moving the market. So everybody can dump on them. So yeah, but having sorry, but coming back to the JAI side of things, right? I mean, there is one thing we always talk about, right? Risk management. There are only two aspects we look at, right? Either it is hard coded into the code, so basically it looks at there is no objectivity to it. As in, it looks at the numbers, it makes a decision, goes with it. But risk management is not only about the numbers; it's very much objective as well. So I think that's where JI stands apart. As in, there is a lot of work that has gone into it, saying, yeah, you have to look at the numbers, but you have to be objective as well, saying what is happening in the market, and then that gets fed into a JI in different aspects, and I think that's where it makes a decision. So yeah, that part of risk management I wanted to come in, as in saying it's not just the numbers.
Yeah.
So there is a reason why we're able to do that. And that involves a little bit of AI education that I can impart in over here so that people understand the difference between the agents that they see in the market and what we do. One of the most important, if it's fine with you, if I can explain it in a short term.
Yeah, so I think this is an interesting point. I was going to say, oftentimes this show is really trying to be focused primarily, at least in this first part, very much on the price action, give us some kind of market view that someone can take and say, okay, I get a general sense for where this is all going. But we're going to do a little bit of a departure, talk a little bit about AI. One of the reasons is that I think this theme is going to be really, it may have started in 2024. I think the narrative is just going to continue to build in 2025. And it's not just that it's going to be a narrative like we've seen in crypto that we're accustomed to seeing about where capital is going to flow into these various names. I think the expectation is really more around the development of capabilities that you're going to see out in the wild. And that's meaningful, that's impactful, and that's going to be here relatively soon. So you're going to hear probably more of us talking about this, I think, with the lens towards giving everyone a better education and thought about how this actually works and be able to screen between the real and the fake, because a lot of it is fake. A lot of it is just marketing. And we want to be a bright light to hold that. So that's my PSA as you kind of give a little bit of an insight into the difference between how you guys are approaching AI. Maybe some of the other people are talking about it. So Benjamin, back to you.
Yeah, so one of the most key components, and I keep talking about it, and I think even in our Discord, we had a discussion a few weeks ago about this, is that the things that you see on Twitter or people coming up with, imagine you have a baby and you basically feed in the encyclopedias and Wikipedia, all of it as a database, and you give it to the baby, and basically you say, now, hey, baby, you are 21 years old. You are educated and you basically can handle yourself, right? So that's what everybody is doing right now.
I do feel like this is an AI description giving about it. We're talking about a baby. All right. I'm sorry. I got to come in there. All right.
Feeding in information for it.
Yeah.
It can know all of this information. Probably it can even answer it, but it doesn't have the experience, right? Sure. And this is because of memory being an issue. and nobody is working on memory side. And luckily or unluckily, we were always working on the memory side, which is why we have a lot of cost. Now, why does memory matter? Because not only are you having existing training data sets and existing processes that basically happens that goes back into the system, you also have the outcome of what is happening go back into the system. And when that happens, you are basically also learning from experience, right? So why do you become a better trader? Is because you keep learning from experience. You know what mistakes you have to make and not make. Now, when you just put like a smart English speaking interface in front of pre-hard coded actions, then it is basically a smart European trying to sell real estate in Dubai rather than actually selling Dubai real estate because it is good.
Ouch.
So that's the exact analogy, to be honest. And now to the baby part once again, it's like what we have been doing for 8 years is growing the baby. What people are trying to do is basically feed in all the things with API and say that the baby has grown. That's where the difference is, and which is why if there is any moonshot for anyone in the market apart from OpenAI with respect to achieving AGI in the next few years, it is definitely not anyone who's having a lot of mindshare in CT right now. It would be us or people who are established corporations like Perplexity, OpenAI, and that cadre of people. Why? Because you don't have models which you have trained and grown up for years together. So it doesn't have the memory, it doesn't have the experience.
So I think just from a capability standpoint, and if you look at this, and again, you guys are the engineers actually working with this. I'm kind of the bystander, but from what I can see, there's been a lot of work over literally decades that led to what we've seen over the last decade, which is this LLM proliferation of these LLM models, which really came out a couple of years ago. ChatGPT really popularized it with its interface. To your point, it kind of built this really nice interface, gave a 21-year-old all the information it could in the world and said, okay, now talk to people. And that's very novel. And it's very, very impressive to a lot of people because we haven't seen that technology in the wild today. But there's other capabilities that are lacking. One of those is on the memory side, where it's able to learn from its actions, and then be able to take action. I mean, there's a lot of discussion out there around the fact that, AIs can learn. Well, to your point, there's not a lot of investment on the memory side, and without the memory side, it can't learn the same way. Is that a fair statement?
Yes, correct. Like,
okay,
it will become a memory which is like a database. It doesn't become conceptualized. It's not able to have that experience. So you can basically take all the Godfather movies and feed it to it, but it will not feel Godfather. It will not know objectively why the movie is beautiful, right? I'm not even talking about emotions, but about valuing what it is able to get as a data, right? And that comes because you are providing memory. That comes because on every step, it knows what it did and it is able to learn from it. Like in a simple example, you have ChatGPT right now. Why do you think you are deploying a separate session in order to talk to it every time? The older sessions basically don't work properly, even if you refresh 100 times, right? So every time you are deploying a session, think of it like you're going and erasing the memory of the child and deploying a child at 10 years old.
Oh man,
every single time.
This child talk, we got to get a new analogy, man. It just sounds creepy on some levels. Okay, yeah, but I think your point is made. Ahmed, I feel like you had something you wanted to come in here with. Did I hear you say something you wanted to share?
No, I was coming back to the same point that Bhagesh is saying. I mean, we are concurring on many things today. It's basically the understanding and the experience that goes through. And on JAI side of things, that's definitely from last 6-7 years. That's what we have been doing. It's basically the growing pains that is going into the model. And the memory side of things, even if you have an understanding of it, I mean, it depends, right? You can just pick up the data, feed to the model, and ask a question. That's one thing. But you as a trader sitting at looking at the data and then saying, nah, this doesn't make sense, or this is where I want to come in, or this is how would I do the risk management. So all those experiences has to be recorded, and that's what we have been doing on the JI side of things. So given to 2025, I think as Benjamin is saying, right, if anybody has a really a moonshot, we have a very good chance at it.
All right, Benjamin, coming back to you. I mean, in terms of getting, from an investor standpoint and getting access to this, is the best option really just to be using these types of tools, the ones that actually have put in the right kind of investment, the right kind of engineering?
I think so, yes, because it's not even sometimes about pedigree or whether you come from Harvard or anything. It's about like how well is your model capable enough? Does it come from years of experience? Because of the model that basically got trained to serve your specific purpose. This is where a lot of differences is going to be between general purpose and specific trading purpose, or crypto trading specific purpose, be it on-chain, be it text, perps, be it centralized. There's a lot of nuances, and everybody is just thinking like you plug it in with the OpenAI API, and then you've solved the world's hunger crisis. No, it doesn't work like that. Yeah.
Exactly. I mean, I want
it's
to
good. It's exciting. It's good steps. It's first steps. But seriously, you cannot spend $20 subscription and think that you have solved AGI. You did not.
Well, yeah, there's been a lot of discussion last year that so many websites came out with an AI capability. And it was really just call it a front on top of an AI, which was an API going into OpenAI. To ask questions. And we could talk about this for a long time. I've got my own personal experiences. I think there's a lot of people that are like me that are open to new ideas, and they want to see the novel and they want to see the utility kind of combined to actually give that innovation. And to date, they've seen a lot of the novel types of capabilities. It's great to be able to create an image in Midjourney or have this kind of discussion in ChatGPT. A lot of the utility has been less impactful than I would say. Than I would expect, especially if I think about like the Gartner hype cycle of where we are today. Is this just being overhyped? Is it going to transform everything? Versus, are we actually on the precipice of the changes actually starting to happen, the impact starting to happen? I guess, before, because we could talk about AI all day. That wasn't the intention here. I think maybe I led us down this path, but I guess maybe we can end with that sort of. And then get back to a little bit on the price action side of it. Do you think that these changes are right about to start to happen? People are going to start seeing a lot of that utility starting to be delivered coming into 2025. Is it still a ways out? Or is it just going to be in fits and starts where you see certain pockets and areas where it really starts to go? And this, we talk about J, it has the memory built up capability. It has this ability to manage risk in a sophisticated way that even to the human eye almost looks imperceptible at times. How do you guys view that when you're looking at all these AI agents? And Amit, I'm going to start with you and then come back to Benjamin. And let's finish off with Bitcoin before we get into the rest of the tokens. So Amit,
on the AI, on the agentic framework, right? Definitely from our perspective, I think there will be a lot of changes coming in. I'm not sure because with respect to the rest of the market, it's quite scattered. I mean, you see video editing is the theme at the moment. Video create generation is the theme at the moment. LLM is there. But actual financial models, there are very few foundation models that are there. And there is a bit of work going on in the background. And we are doing quite a lot of work as well. So once all those things come to fore, I think on our front, there'll be a lot of changes that we'll see. And that agentic framework, I think that will have a lot of value.
Okay, so you think this is on the mark. 2025 is going to be the year where people are going to see material impacts, not just sort of the novelty, but the utility as well.
Yeah, and definitely from our end.
Yeah. Okay. All right.
I think overall,
Benjamin, come back to you.
I think overall as well, I think we'll see a significant difference compared to last year. Last quarter, the AI agents or whatever things that were coming up, I think that you can call it as a mini wave one of sort. I think a wave 2 is coming, and that probably is going to be a bit smarter. And people realize that you cannot simply run a Twitter bot. It's so expensive. And there will be a better utility version comes in. It's not about launch pads. Then there will be an even better wave that comes in, which people come and say, okay, everything is crap, and I just like these 5 products. And that
I think
builds the base.
I think that would be the first half of this 2025. Where there'll be loads of different products, loads of different thought process that will come forward, and then towards the end of it, that people will start consolidating. So, okay, this is what works for us. This is the route we should start taking. A classic example is deep thinking. So initially, when we started with LLM, it was like for speed, right? How fast you can get the answer. Then the question was, is your answer correct? No, it's not. It may be correct, may not be correct, but have you thought about your answer? So then the deep thinking started to come in, saying, okay, we need to think about the answers that LLMs are giving. So it will be 2025. I think it will be something like that. Initially, you will see a burst of products come out, and then it will kind of narrow down, saying, okay, these are the things that we need, or these are the things that work.
If I can plug, and then let's get back to Bitcoin. I want to plug one of my requests. I want more questions coming from the AI. I mean that because every time I go to use, let's say, ChatGPT as one example, I put in a prompt, some of it very thoughtful prompt. It comes back with answers rather than asking me questions to clarify and refine. If there was that capability, I think that would 10x the value of any of
You'll be surprised to hear this, but this was a request that came from a AIF fund manager as well. When I was talking to him in DIC, AIF in the sense in Middle East and Asia, you call them as a hedge fund manager, okay?
Mm-hmm.
And he was asking the same question. I have to basically go and ask an LLM model what I want, and often I'm like, I want a challenger who comes and asks me questions for me to come up with better thoughts on what I want.
Mm-hmm.
And nobody's building things like those because it's harder to do, and you have to do domain expert model for it. You cannot build generalized models for it, right? And everyone wants to build generalized models because they think they can become a rent shop. The whole idea of the AI infrastructure, everything that is being built right now or being deployed, is to be able to rent, whether it is GPUs put on rent or compute put on rent, or let's say the virtuals type of models and DAOs.fund type of models. Those are all infrastructures where you're renting to deploy your token. It's all about renting, right? So when you focus on renting as the primary objective, you will always end up focusing on generalization. You will not end up focusing on domain expertise.
Are you telling me that incentives matter?
I
Design
think
principles
the
matter.
biggest problem most of the people in the industry have is that they don't have any revenue model. So if they do not end up doing something to first incentivize themselves, they don't have motivation to build, which is where we are smart and dumb at the same time. We focus on burning our cash, making money, and then burn it once again in order to keep building.
Yeah. Well, I think I remember an entrepreneur. I'm trying to get his name. I think it was Jeff Bezos that maybe did something like that with Amazon. Yeah. Okay. All right. Well, let's bring this back to crypto, guys. We're gonna have to come back. I guess for all those listening, would love to hear your thoughts on what you think of AI agents. There's obviously various narratives that people are looking at. Some of it is going to be how am I using them. Some of them is just going to be the crypto narrative, which is really about investing. And we've obviously, I think on this show we've kind of touched on it, but we haven't talked about all the AI agents that are coming out or the AI adjacent type of crypto projects. Real world assets, what that might look like. It's a very wide open space. I think a lot of it, again, is marketing. We're going to have to come back to that. But for today, let's get back to the actual trading, bring these guys back. You do know now, and hopefully you get an appreciation for the type of thinking that these two guys have done, plus the actual engineering and the programming to come up with what Jay is and why we talk about it so often. I use the product. I've talked about it on a recent video. You can go check it out on our YouTube channel. I'm a huge fan of the product. For the reasons that they've described and the work that they've done. So that's why I will always talk about it in such a favorable light because I use it and I'm happy with it. But you should go check it out, see if it's something that could work for you and how that could help you manage your portfolio, especially if you're someone who ends up FOMO trading and losing, which I guess, you don't want to be a tourist. You got to be happy with 50% drawdowns. Maybe that's the 2025 resolution is to come back to that. Amit, I want to come back to you. Let's look at the price targets for Bitcoin. What is this telling you as we look at the live price chart? It looks like we're having a bit of a pullback, maybe go under 6 figures. What are you looking at trading this week? Is there a trade for Bitcoin?
There is a trade, but you have to wait for that. It's the same setup that we get week on week. Monday it hits the high, Tuesday it goes and retests the Monday low, and then does a wick and then runs up. So today what I'm expecting is basically it'll come down to Monday low, that's 98, and a wick down to 95 or 96, and then run up again. But if it doesn't close above Monday low, you don't have a trade. But you have to wait for this trade to come in.
Okay.
You cannot basically, generally what we have done in the past when we had a good conviction on it, basically you can take a trade from Monday mid to Monday low, or the last pivot point, in this case it would be 96, and then your risk sits just under Monday low so that you have a rundown, basically fills and runs back up, because that gives you a structure of higher high, higher low, runs up again, higher high, and runs down again. But today I would say, because it is going towards the previous month mid, so that's sitting at 99k, and it has been considerable support and resistance in the past. So if it goes below that, you have to have some bit of a caution, because it can break down if it has to. As in, there are loads of micro events or macro events that is going to happen. So it's a bit of a caution for first this week and the next week.
Yeah, and you mentioned a bit of caution. We won't necessarily get into it because of we don't have anybody here that's really tracking and trading options. But I know there's a big options expiry coming from MicroStrategy. There's been some analysis on crypto Twitter, but you talk about some of those outside forces. Those could, have a significant play on whether or not Bitcoin at the ETF level or even spot could be dumped into the market. Play into this. It's really something to monitor, but I'm not sure. We don't have an opinion there, but yeah, I definitely have to look for those breakdowns.
So, what you have to consider is, right, even if you start to take a trade from Monday low, let's say if it breaks down and comes down to 96, you don't take a trade there, but you wait for it to come back to 97 level. Monday low is up, and then still you got 5% gains here.
Mm-hmm.
Even if you take the trade, if it comes back and then start trading from there, even if you have to chase, right, between Monday low and the previous week mid, in this last 2%, you can chase the market. Basically, you can come in with the multiple limit orders, and then it'll fill and run up. But you have a confirmation here. You have to wait for the market to show its hand rather than jumping before or trying to front run the market, because these are not, specifically these first 2 weeks are not the conditions where you should try to front run the market.
Okay. So definitely some good risk management guidance there. What about layering in bids? You talked about it coming down to a lower range. Are you then even from there layering in bids going further down, or are you able to kind of stack them at that level?
Yeah, I mean, with the exponential that we have in JAI, right, you can basically stack them right at the bottom. So if you take let's say this 3% or 4% trade right from here, from Monday low, or basically from previous month mid to 96. So last 3% of the drop, if you want to pick that trade and then set the exponential to, let's say, 1.2 or 1.25. So that's where all your bids will be stacked up. So it'll have an exposure, but it'll be very less exposure, just in case, because if you have to cut the trade right after 96, because this is the area when we went down, right? 95 is the area was very difficult to break, and then it ran up from there. So these are the red candles that you see. It's basically significant volume, but nothing happened. So market tried to push down, but nothing happened. Everything got bought up, and then it ran up. So this red candle specifically here is a very significant area, and this is where you want to take a risk, because if it breaks down from here and if it anything closes below at this level, you can just cut the trade. If it goes to 93, 94, you can cut it without hesitation, because then it's going for the previous month low. Then it is going to clear out 94, 98 levels.
All right. Always seems like clockwork when you show this up. You've been running these trades, and we've been talking about them for months now. How do you feel? I mean, I'm not sure how well you're able to catalog your success and failure rate, given that you don't sleep and you're in a garage. But how do you feel that these are playing out for you?
I think we did some analysis, and we had a hit rate of around 85 to 86%.
Wow. Do you have the return? You said a hit rate, but when you were talking today about a 5% gain, do you have any analysis on how they perform? Are you averaging 1, 2, 3, 4, 5%?
I think it's around 6 to 7%.
All right, 6 to 7% on 85% hit rate. Wow, you could definitely have one of those Twitter threads about you only need a couple of you're only a couple of trades away from hitting your dreams and buying moving out of a garage. Maybe that's the best way to frame it.
No, I mean, the
Yeah,
garage is just live.
What's
in meme coin sign, they say flip 10 times and you become a billionaire.
Oh, that's right. Yeah. So says the guy who's selling the marketing for it, right? Okay. All right. So there you have the trade for Bitcoin, as well as a deep dive into the on the ground engineering it takes to actually make one of these LLM models valuable. We'll definitely be coming back and talking agents more on this show as this year gets on. It sounds like the opinion is that we're going to actually see some material use cases, and which is pretty powerful. We want to make sure all of our listeners and followers are here for it. Anything else from a Bitcoin perspective before we move on to Ethereum?
Not really. I mean, price action is quite clear.
Yep. Okay. Well, let's do that. All right. Well, let's get into Ethereum. How are we looking there? We're going to have Ben Lilly. I think he's able to join us shortly. He's coming out and he's going to be talking about a thread he had about Athena and the fact that it's muted price or potentially muted price and what that might mean going into 2025, which I know right now we don't really care about. It's really just the price action. Last week, Amit, you were saying stay away. This one's a dead dog. What are you looking at now? Does this have a little bit of life?
Ethereum is dangerous, man. I mean, to be honest, the way it is behaving, I mean, these 3-4 candles, right? I mean, that took away all the confidence I had in Ethereum. So it's basically doing nothing at the moment. It's just sitting at I mean, if you look at it, right? I mean, it's on a daily chart. It's already below Monday low. So you don't want to touch it at all. There is no trade here.
Yeah,
No.
I agree with this.
Well, okay. So when is this going to start getting into territory where you're looking for that trade?
If someone wants to risk it, I would say 3,400, 200, and 100 are good entry points. It's also the support volume-based support zones from the run-up in November and December. So those would be good entries to attempt it. But we need Ethereum to stay above 3,600. It needs to close about 3,600 on a weekly candle. Until then, it's a little hard to trust the price action.
Yeah, if you look at the price action now, it's just looking so shocking. It's just dying like anything. It's wicking down to 3,500. It's just absolute shock.
Yeah. Well, maybe we'll get a little.
I think altcoins as such are taking a hit because BTC dominance is going up, and I'm not sure how to read into it yet. We have to see how Tuesday plays out, but I don't think there is any urgency to basically come in and take risk today, to be honest.
Well, yeah. I mean, when I hear someone say, if you want to take a risk, it feels like it's the wrong type of thinking. You're at the wrong starting line. It really should be, is there a really nice setup? And we've talked about that, either on the option side when we had JJ on here a long time ago, when he was looking for these fat pitches. And even with you guys looking more on a week-to-week basis, what's the trade? It feels like, listen, you don't have to take a trade every week to be successful. If you've got good trades, take them with good risk principles, and you're setting yourself up for success.
Yeah.
I mean, again, another PSA.
Ethereum, I don't think we are in any of that spots. I don't think there is anything interesting with Ethereum right now.
Okay.
So it's like, let it show itself a bit more, and we can then see.
And when we get Ben Lilly on here, he may be giving a little bit more of a perspective from a long range, give some of those longer term investors a little bit more excitement about maybe DCAing into the asset. All right, let's move on to Solana. I'm curious what you guys think about that, because you guys did say you thought Solana was going to outpace Ethereum when alts start to run, which looks like it may be coming all the way out of February or March at this point.
Yeah, so basically how I see Solana is that it definitely did a better recovery than the other majors, to be honest, once the new year opened. So it definitely did like 20-25% growth, which is good. And now it went back up, retested the 220 zone, and it's not able to break through. As you see in the chart I'm sharing as well, there's so much VWAP resistances, and now it is retesting 200 moving average on 4 hours. I think we lost the Monday low on Solana. So we have to wait and see where this pulls back up and consolidates. If it goes back below 200, it's bad. We have to basically, we'll see a lot of blood in, the meme coin side and also on AI agent side if that happens.
Do you? Yeah. So sorry, I just want to ask a question. So you had talked about before kind of a 3-point trade. It was I think it was 220, 200, 180.
Oh yeah, that one is in profit. That is in profit.
Okay. That's still been a good trade for you.
Yeah. That is still good.
Okay.
Because all those orders got filled, and it is right now in profit. But let's see.
That's the way of the market. All right,
I'm
Ahmed,
not
what
being
about?
adamant about it. If we lose 200 on a daily, I'm getting out because it's in profit, so I don't need to basically lose money there.
Fair enough. Well, Ahmed, come in here. Let us know. Are you seeing a trade for Solana? Maybe something you aren't seeing on Ethereum, or is it really just hands off this week because the ranges just don't look strong enough?
This is the part that is concerning on Solana. This is a liquidity grab. This generally happens before the good sell-off comes in. So I'm expecting equal lows coming in previous week low, 180, 185, because this should not happen on a healthy structure. This is basically come up, create a Monday range, grab the liquidity, dump down. It's already below Monday low. So yeah, I think it's going to drop further down.
Okay.
So if you're looking for longing, there is no trade here. If you're looking for shorting, yeah, it's a risk. You can ladder it all the way up to 220 if you want to, and then cut if it crosses 220. Otherwise, you can add it down to 180, 185.
Well, there you go. That's how you can ladder in and get a trade. But it sounds like this is one of these weeks, and maybe a good time to be risk off as we kind of head into the new year, and we're seeing a pretty good pullback already on Bitcoin. All right, I got one last token here. I'm taking from the Jumper Screener. Everything is either neutral or bearish, including Solana. So we'll have to see about that. But I'm going to take the top one, which is one of the best punching bags in crypto Twitter, which is Cardano. Looking at ADA, it's neutral. So I guess Jay's coming back and saying, I don't really have an opinion, but if you look at this, I already have a guess as to where this is going to go. But why don't you guys tell me? It looks
good, actually.
Oh no, okay, I was wrong. I have 50-50 chance there.
Compared to Solana and ETH, this is strong.
Yeah. What the hell?
Yeah, this is strong.
All right, what are you guys looking at from the actual trade setup?
No, I'm not trading this. I've never traded this. Like, it's been a long time since I traded this. But if I was coming fresh into crypto and I'm using Robinhood and I end up in Cardano chart, there is no freaking reason I don't end up buying this.
It has done 35%. Since first of Jan. So yeah, you can basically, if you really want to take a punt here, right? You can basically take a trade. You can go from here all the way on the risk side, right?
Yeah, you have to go all the way till 0.8 though.
Yep. So I would say,
you can, cut it if you lose $1.
Yeah, exactly. Previous week mid, it loses, you cut it straight away. You can ladder it down all the way here, see how it plays out. Because see, even if it comes from the top, even if you put the fib on, right, it will be around your 60-62%. So this would be a good entry point to play.
Okay. Any thoughts here? So this is an interesting setup. But is there any reason that Cardano would outperform if we're seeing a pullback in Solana, Ethereum? I feel like the L1s really like to party as a gang. Or you can correct me and say, no, actually, we've got these outliers that happen.
I mean, it's just a sentiment. I haven't gone into the details of what is going on with Cardano. It's just coming up the chart, so I'll just trade the chart.
Sure.
It's just under allocated, and which is okay. It doesn't need to be over allocated. Definitely, nobody should allocate into it, but it's under allocated major layer one, which has volume, which has a bit better order book liquidity and so on, and a lot of cash and carry funds basically use it as a way to get volumes. many market makers basically use it as a way to get volumes. That's why you will not find Cardano with less than 50 million per volume on any day. So that's because it's a easy token to basically hedge as a beta to any of your existing trades on majors and stuff like that. LTC, BCH, Cardano, there is a reason why they don't get delisted, but instead get added to indices and so on. Not because they solved some global hunger or something, but just because these are tokens which have had good volume. It still has foundations which operate. It just helps traders. Simple as that.
Long something, short Cardano. All right.
Yeah.
Keep it simple, right?
Yeah. Do that once we hit the top. Cardano is the asset that you want to short because it will be so comfortable to ride it down 80% drawdown on that. Even if you end up holding your Bitcoin, if you want to hold up your Bitcoin, you can just short Cardano in the same amount, and if you don't want to sell your Bitcoin for that matter.
Yeah, and if you've got questions about how to do that in a sophisticated way, you can reach out to these guys. They can talk you through it. I would DM them. All right, guys. Well, that takes us through the usual suspects. Anything else before we move on? And I'll ask the producer here if he can DM me. If Ben Lilly's here, we can get him on. But is there anything else you guys want to share before we wrap up this segment?
Yeah, I'm good.
Yeah, I would just say relax a little. You don't really have to risk it.
So this is coming from the man who says, "Do as I say, not as I do," because he's still not getting enough sleep. But I think that's probably really good advice this week.
That has multiples of reason, not just trading.
Get a little bit farther afield. Hey, he's not in his garage yet. He hasn't been kicked to the garage yet, so he must be doing something right.
Yeah, he's not trading enough.
Ahmed, anything from you?
No, I'm good, thanks.
Okay. All right, guys. Appreciate it. Always love hearing what your thoughts are on the market. And hey, if you're out there listening to this and you want to hear more about AI agents, let us know some of your questions. We'll see what we can filter in. As I said before, I think this is something that we want to definitely put a spotlight on, not just because we have analysts that are looking at it, but we've got guys that are actually building in the trenches that can provide some really good firsthand thoughts on what is and what isn't. So definitely you're going to want to stick around and hear what they have to say. And last thing I'll point out, there is Jay that's being traded on chain. I know there's questions about marketing. That's all going to be updated. But if you've got interest in that, because you don't quite know how to be trading some of this stuff, something to consider for your portfolio. Guys, thank you. Ben Lilly, are you with us? No, he's not here yet. Oh, okay. Let's see if he's going to be able to join us. All right. Well, I guess we're waiting a minute or two to see if we can get Ben in here. So I have to make some stuff up. Oh, okay. All right. Well, then I can cut my soliloquy short. I'm sure you guys are tired of it. But well, we're starting to get Ben on here. I would say go check that out. And you should be asking yourself, what are your 9 principles that you're adhering to make the most out of this bull market and the subsequent bull markets? We still operate on a four-year cycle. That's an amazing opportunity for any investor to be able to make the most hay. And so you got to be asking yourself how you're using some of those. And I would go check out that video. Let me know in the comments what you think you're doing to be long-term. And are you using tools like Jay on Chain, or are you doing something else? So Ben, are you with us? Oh, I'm not hearing anything just yet. Oh, Ben. Oh, here we go. I just heard your lovely voice. How you doing? Oh, okay. Well, we're gonna have to see. We had to give him an extra shot of espresso, which you know all too well. Um, we got a lot to cover on the flow report, including the write up that you had on Athena. So we're going to get to that. But before we do, I want to ask, what is your 2025 resolution? What are you doing to make yourself a better man?
I think one of my main goals is actually to stay off of Twitter more and try to, because it's just, there's so many, honestly, if you follow the right individuals, there are so many good ideas. It's easy to get distracted. And before you know it, you've essentially lost, 20, 30 minutes of your day. So at the same time, it's beneficial because it helps you find interesting ideas and anomalies in the market. And then on the flip side, it's a sinkhole of time. So trying to create that consistency day to day, and really trying to find better news sources of long form. That's kind of a goal here. Substack or folks that write on Ghost, or even just trying to find subtle good media sources that maybe outside of the mainstream media is one of my wishes for the new year.
So it's really about being able to control your information flows, both, what's actually in them and where you're getting them, and as well as being able to, I would say, even master the ones that you have, so you're able to get something from without stealing all your attention.
If I could have my office be a bunker, right? I want to really kind of control what's coming in, right? And kind of allocate my time the right way. That's how I kind of see it. It's the only way I can be as efficient as possible. You heard them talk about all the things that we're building. It's just there's not enough time in the day right now. Things are moving so fast, and we want to get stuff to market. We want to get into consumer hands. We want to hear feedback. There's just so much stuff we want to do right now, and there's just not enough time in the day.
Yeah, absolutely. An information bunker for 2025. I like that. I think that may be perhaps one of the top principles. In fact, I think I talked about that. It was principle number 8, maybe, about filter out the noise, really limit what you're taking in, because you can be distracted all too easily in your investments, but I think just in life in general. But okay, I think that's a good one. Let's get into the flow report because I think we've got a lot of interesting information to get through today. For those who are new to the broadcast, Ben's always coming in with the information of what are we actually seeing from a supply-demand perspective. He's got a lot of interesting analytics, some of which he's pulling from other sites, sometimes coming from internal sources. And we are always going over the majors. Sometimes we're able to talk through some of the other ones as well. But I know today I'm assuming we're going to be going over Ethereum, Bitcoin, and Solana. Ben, where do you want to start?
Where do I want to start? I think one of the important, if you were to take a step back from the market and we kind of see where it's at, and it feels like it doesn't quite have, the ability to kick it into another gear. Right? It just feels a little sluggish. Mm-hmm. And if we could take a step back and kind of understand maybe why that's happening, it could be beneficial. Maybe it's not. Maybe it's useless. I don't know. But you guys make the best judgment of that. And to do so, it comes down to kind of one of my favorite topics is rates. I know it's, again, like watching paint dry, as I mentioned yesterday when we were looking at, I made a tweet regarding the stablecoin activity on Coinbase. Rates is probably falling in the similar bucket of just, this is so exciting, right? Borrowing rates, it matters. Okay, I don't care what anybody has to say about this. We look at, what was everybody tracking in 2023 when it came to the traditional economy? It was rates. It was what was Jerome Powell saying at the mic? What was going to happen in 2024? What was going to happen in 2025? And I'm already getting my ears mixed up. You can tell my sleep's a little deprived, but when it comes to even on-chain borrowing, it matters. In the same light, when rates start to get high, things get constrained, right? The cost of capital is going up, and it's harder to go ahead and find that next source of capital that exists on-chain. And it's kind of a unique environment because it all has to do with either collateralized treasuries or, all the different things that Tether has on their balance sheet and able to go ahead and, mint those USDT tokens. And same thing with USDC, right? The supply of stable coins, the supply of dollars and liquidity that exists is almost its own little microcosm that exists within the global economy, right? It's different, right? It's not fiat dollars. So there is a limit in terms of the amount of supply that exists. So, if we were to think about liquidity or really the ability to move the market as like a string hanging from the ceiling with a weight attached to it, when rates get really elevated, it's harder, with in terms of to push the string forward if that weight keeps getting heavier and heavier as those rates start rising. And so you want to have some rates because now you don't want to push on a slacked string, if you will, with rates just completely down in the bottom because you don't really have that counterparty on the lending side, right? You're not able to attract the capital, right? So you have to have that happy medium where there's enough weight on that string to where you're able to push it and you have some resistance, but it's not too much. Okay, so that happy medium, if you will. And so on my screen, I have the borrowing rates for.
We're not actually seeing anything just yet. Let's make sure you're sharing. Oh, okay. Let's see if we can get that in.
Yes, sir. I thought I was. The 4-screen share, I'll click that again. And let's see. You want to share Panda Terminal. Let's get out of this screen share. Okay. Do you have it up now? Okay. Well, what I can do then instead is I will send you a screen grab, Marconi. I don't know if you're able to pull this up on your screen, but while we try to diagnose this on the back end, I can at least go ahead and continue to talk about it. But did you see the image I sent you?
Unfortunately, I don't usually have this either. Let's see. Okay. Yep, I see it. Yeah, I see the image. It's a nice image with a lot of data from Panda.
I'll try my best to explain the visual. So USDC, right? We can track the borrowing rates over time across various different protocols like Aave v2, v3, Compound, Curve, and I think there's one more. But what we see is that back in early 2024, when the market was getting really overheated, rates were getting elevated, and the rate at which that was happening started to accelerate. Right? And this was kind of in early March. That sort of acceleration in how expensive things were getting was, you can almost think of it as an RSI indicator. For those that understand technicals, RSI is a way to see, the speed at which price is moving, sort of all that momentum. It kind of gets overextended, right? Essentially, it's getting overbought is another way to think about it. And so it tends to hint at the possibility for a reversal. So if we kind of think about borrowing rates and the rate at which they move, we can kind of think of it like that RSI indicator, where if it's starting to accelerate too quickly, essentially that next borrower is looking at that and saying, whoa, I'm going to just kind of take a step back. Things were just, say 10% yesterday, and now I'm looking at 14, 15%. Maybe tomorrow will come back down to 10, but let alone it goes to 18, right? So now that next unit of capital is sitting on the sidelines and becoming hesitant. It's getting kind of cold feet. And so that's the way that we can think about when rates start to accelerate, is the creation of that capital, that fresh powder that we were just talking about, right? Because in our microcosm, there's only so much dry powder that exists at any given moment. It's very hard to create it compared to the traditional economy. That creates the conditions for pullbacks. That creates conditions for it's harder for price to move higher. Well, we had that starting in November, looks like the 23rd was when kind of my indicators started going off. And then the market topped out about 2 weeks later. It has pulled back since then. But if we take that step back that I was referring to and we look at like how elevated are these rates, let's smooth these rates over time. So applying a 30-day indicator or 30-day moving average to a specific rate, I think I used Aave V3 because I do like kind of the stability of their rates over time. We're elevated still, right? And so if we really want to move forward, not only do we need to have a kind of pullback period, this reset, refresh, it really needs to come down even more. And so if we're going to be rising, and granted, it has pulled back quite a bit, and the conditions kind of hinted at it, and I had these little green little bubbles showing that, rates have pulled back enough to where that capital on the sidelines is coming in, right? And we have that. We had a nice little push on the price. But relatively speaking, you take those couple of steps back, we're still up there, right? So are we going to really continue to push higher with the rates where they're at? I find that hard to believe. I think we need a little bit of a longer setback. But what's interesting is you compare that all these rates with what was going on in the ETFs yesterday, but that's another story. So really that was the first thing I want to hit on is let's just look at, how expensive is everything right now. And it's up there, right? We shouldn't shy away from that fact because I know everyone likes to look at perpetual markets and what are those rates at? What are the funding rates at? Oh, we had this reset. Everything is great. Good, right? But we have to remember a lot of trading activity has actually moved on chain. So as reliable as funding rates were, they might not be kind of give you that full snapshot of when a reset is taking place now. In order to assess that, we do need to look at the markets on chain, and we do need to have a little bit of a pulse on, where are we, right? Where is this perspective? And so it kind of matters if you're looking at a 15-minute chart versus a 1-day chart on that approach. So that's the first thing I really wanted to hit on.
Yeah, that's a lot to digest, and I apologize for not breaking in there. I was trying to get the the graphic up because there was a lot to unpack there. I guess before I try and go back to that, what you're really saying here is to be looking at sort of the funding rates as this way of saying, are we overheating? It looks like we are. So it looks like a cool down is kind of anticipated, which goes back to a little bit about, the conversation we had earlier in the show was a little bit more just this week. We're looking for a little bit of a pullback just based on the technicals, where you're saying it's just the market is overheated from a rates perspective, for the funding rate perspective. Did I get that right?
Funding rate,
not funding rate.
Lending
rates. Yeah, I used that wrong term. Lending rates.
Yeah, so it is elevated still. We did get kind of like a nice reprieve here, where we could see some more kind of credit become established, some new loan originations take place, fresh dry powder hit, but that's just going to be kind of a momentary thing. And I don't see rates getting. I was like Gearbox was up over like 30%, almost 40. Looks like it did touch 40% for a little bit there. And even on, I'm sorry, that was Aave actually. Yeah, that's so people that don't know kind of how Aave works. Like when the amount of kind of supply that exists is getting scarce, it has a bit of a hockey stick approach into how the rates work. So it's what was maybe 12%, 15% yesterday. You hit that hockey stick moment, you're at 20, 25, 30% real quick. And that really just helps, keep the system in balance. And a lot of, because they have the flash bots, right? So they go ahead, these bots can go ahead and take these opportunities that exist within the same block and make these kind of arbitrage transactions on chain. And if they're still making those actions and activities, on chain, that's going to contribute to this hockey stick. And those are the actors that are still, taking out those loans kind of from second to second. But as those rates continue to stay elevated, the amount of opportunities that do exist to engage in arbitrage on chain start to become limiting. Right. So now you just have less transactions happening on chain because of, these additional constraints that take place within these rate markets. And so just the fact that, price is starting to rip, where there's a lot of activity, there's just now the cost of capital is getting so extreme that even these arbitrage opportunities that do exist on chain are coming down. Right. And this is sort of like that economic growth kind of consideration in TradFi, where like rates are so elevated that we're going to hit a recession or something. Well, this is actually kind of similar, right? A lot of the economy is just the ability to go ahead and sell goods and services for a little bit less. A lot of it is just arbitrage in the daily markets. And so if we can't go ahead and do arbitrage on all of the things that kind of existed maybe a week ago, right, you're having a slowdown, right? And the fees are starting to get pulled back as well.
So Ben, taking, let's say you have someone who's listening to this and thinking, okay, I hear what he's saying. He's saying that these lending rates are suggesting that we're in need of a cool down from a marketplace perspective. We would expect to see some sell-offs. There's other narratives that maybe you're going to be hearing as well in the market. What are the indicators that you're looking for that this is just starting to reverse? Is it really just the lending rates starting to come down substantially? Are there other things that you're looking for that maybe isn't quite common, or maybe it is common but it's not looked at in the right way? Oh, good, we finally got the chart up. Our producer's working nonstop behind. Hopefully, still has some hair he hasn't pulled out yet to get this up and running. It looks like we finally got it. But again, going back to this, what exactly are you looking for? And then I guess the next question, if you're comparing this to kind of a recession, recessions are oftentimes several quarters, right? But this is crypto. Everything moves very quickly. How much time do you think would you anticipate that this would take before we start to see that reset sort of settle out? We can start to see a buildup again.
Well, okay, so you can see my chart. Good. Yeah. So this red line is a 30-day moving average of rates to borrow USDC on Aave V3. I know that's pretty specific, but that's kind of the market that I like to monitor the most. Hopefully you can see the red line, but I mean, here you can kind of see you're actually
you can see your cursor if nothing else.
All right, good. So you're ebbing and flowing, right? And you can see how price is sort of kind of responding, right? But when it starts to get elevated in both of these, you kind of see a little bit of correction follow suit. Kind of come elevated again, right? And a lot of borrowing is going to happen on drawdowns as well, right? So that's why I like to look at the acceleration period, right? When rates start to really get overheated, because you're going to continue to have those rates start to rise a little bit as those liquidation cascades happen on the far side of any price moves. And so here we are, right? Like this is reaching levels that we haven't seen this cycle. And so we are having a bit of a pullback. And so look at this pullback. Look how long that took. We all know that period. That kind of sucked.
It's one way of putting it, yeah. Well, is that from March to basically September?
Pretty much. Like this is that big lull that took place. Do I think we're going to have that similar lull? I really don't. But I think we're going to continue to have like these higher low periods and these higher high periods of borrowing rates for the next probably 9 to 12 months. And so if we were to kind of draw a circle around this period where we kind of had these kind of higher highs and higher lows unfold over a year, like I think that's the environment we're in. And so if we're going to look at like pullbacks, like I could see like 9-10% being pretty solid in terms of like, you know what, that's enough of a reset. Like let's continue higher. Of course, ETFs could just blow the lid off of everything They are not subject to these markets. That is fresh fiat capital coming into the system, right? And it is just not, these markets are not a constraint for that capital. So in part, that's how we can hit higher highs in these markets, right? Because there's so much fiat coming into the system that the opportunity to go ahead and use, even at these elevated rates, go ahead and use that dry powder to go ahead and take positions and go find out these new opportunities. And what I would almost see and expect to see is, I wouldn't be surprised if Athena went ahead and got active in the lending market in some capacity, because some other protocol needs to come in and become a major player here. Right? There's too much opportunity that exists. If you're going to have lending rates remain this elevated for this long, that is just too much fee capture that exists on the table to go ahead and let the opportunity slip by. Somebody needs to take advantage of this.
Well, what about existing players? I mean, aren't they positioned just to increase the size of their book rather? I mean, they already have the infrastructure, they've got the marketing, they've got the tools. Aren't they already ready to really be able to capture that? Aren't they best positioned?
So you're talking about like Aave?
Correct.
They are. That, trying to think of like, what is it that they're constrained by? Outside of just they almost have everybody kind of built into their lending and borrowing protocols already, right? They're simple. Like we've done it with our on-chain AI, right? It can go ahead and take advantage of Aave lending pools to go ahead and earn yield as it maybe you wait to deploy into other strategies that exist. It's simple tooling. Liquidity on L2s aren't as prevalent. And so if we think about where is the opportunity for growth, that is a place where it can happen. Liquidity does need to show up. Right now in some of these L2 environments, a lot of liquidity and capital is being allocated towards speculative bets, rightfully so. I mean, we just saw virtuals just have an absolute explosion in the past 2 months. I mean, it's January, I think, or early November, it was like sub 50 cents, and now it's over $5, or it touched $5 not too long ago. Like, if you're moving over into an L2 environment, when you have opportunities like that, are you going to go ahead and put like passive capital into a lending pool? No. No, but as soon as those start to pull back and you start to see, those opportunities become attractive, now you have more liquidity showing up elsewhere. And so now we would almost have to take some sort of average across all these lending pools to get a better sense of like how elevated things are. So there's definitely an opportunity there. I haven't looked at, to be fair, like our Arbitrums and basis lending markets, but that's going to be where things move.
Well, that's interesting. It'll be interesting to see which players start to come out. I don't know that we have the time today to get into the TradFi world that's going to be coming for these assets, particularly on the ETF side. But that's another outstanding question I have in my head about where some of these ETFs can start being used as collateral for lending, and what that could actually mean from a exposure and a bubble perspective. But let's bring it back. Let's stay on crypto. That's what this show's about. Why don't we start with Ethereum, because it feels like that's we're talking about the lending markets. That's where a lot of people's heads are already at when they're thinking about, because it is the most robust place today in terms of an ecosystem, financial ecosystem. Ethereum is head and shoulders above everyone else. We just talked about the lending markets, and what that might mean from
you got to have a trigger warning before you say something like that, Marconi.
Oh, well, it's 2025. I've given up trigger warnings. That was my New Year's resolution. I just want to come out of the gate swinging and see what pops back.
Right.
Okay. Yeah. No. Hopefully, I got some people on the timeline telling me that I'm out of my mind. But But yeah, so I think from an Ethereum perspective, I would argue it still has the depth, and I think I'm in good company. I remember listening to Arthur Hayes say something very similar. I guess it was about a year ago now. And of course, he's related to Athena. I think he's perhaps one of the original investors. So, what do we want to start there? Talk a little bit about Ethereum's flows from a demand and supply perspective. Do we just want to leap into this discussion on Athena because price is top of mind for people? I kind of started the show talking about it. Is Athena suppressing Ethereum's price? Maybe people will come with pitchforks coming out after Arthur Hayes.
Well,
but where do we start?
So I first want to at least explain, like, I get called ETH Maxi all the time, and I really don't care, but I do feel like I have to like explain myself in terms of like why I get that misnomer. And I don't spend as much time in Solana and Bitcoin, at least when I write about it or talk about it or even tweet about it. And it's just because, like, I studied monetary economics and macro econ and commodity economics for a long time. And I even had my own stint in TradFi in lending. And so rates is like a lifeblood for markets because that's my perspective. That's where I sit. That's how I apply my lens of life essentially into crypto. So with that background knowledge, like when I go ahead and I look at markets, I try to find those things because that's what makes sense to me. I know that doesn't make sense to everybody. And that's why I joke that like everyone finds it so boring, but that's what I know. And so when I go ahead and I look through the Solana ecosystem, like there's not as much tooling that exists for all those different rates or swap markets or being able to kind of assess those money markets that might exist within that ecosystem. And of course, Bitcoin, there really isn't much to really look at outside of like an ETF flow or like how many addresses hold for how long, right? Like the HODL wave chart that anybody who's been following me for a while knows that I used to talk about HODL wave charts all the time because that was one of the few on-chain metrics that you could look at to understand like what are individuals' behaviors. And so if there's a ton of holders that exist for, multiple years, the likelihood that they're going to sell tomorrow is probably very small. Whereas if there's a lot of holders that exist within, say, less than 3 months, they have a higher likelihood of selling. So being able to just analyze, the potential and kind of attribute behaviors to that holding period, like it allows a form of analysis that exists for Bitcoin. But then when you go ahead and you go into an ecosystem like Ethereum, you have all these lending and borrowing markets that exist. You have all these different rates. Pendle has gone ahead and create swap markets. And so, now you can go ahead and assess these kind of secondary yield markets that are individuals trying to express what they think the activity of the Ethereum ecosystem will be. So the analogy here to TradFi is when you go ahead and you look at the movement of treasuries and you see like the 30-year rising and you see the 10-year depressed or whatever shape that looks like, you hear all these analysts talking about, oh, everybody thinks, maybe inflation is coming or there's going to be a ton of activity in the economy coming. And this is really bullish or, vice versa, right? So you can take all of those, understandings of the market when it comes to rates and you can apply them to Ethereum because those things exist, right? And so because of that, again, my lens, when I go ahead and look at markets, I'm able to see more in this ecosystem. And that's why I spend a lot of time there, and you can ask anybody that's close to me within crypto. I cross my fingers and I hope to see the day that Bitcoin has these markets because I want to talk about Bitcoin more because that to me is pristine collateral that exists. Like there isn't anything else that has really come close to Bitcoin. And Solana, that thing is going to be incredible to watch grow as it looks to become like the on-chain version of the NASDAQ as it starts to bring in, wrap stocks onto its ecosystem. That thing is going to explode. Very excited to see what happens there.
Yeah, I could summarize and say what can be studied gets studied. right? It's you have more information here. You have the ability to take some of these concepts, apply them in a way that you simply can't in other marketplaces. And I think it gets back to the point that was made earlier that when we say that Ethereum is the most robust, it's not trying to be a maxi positionalist or even making a subjective statement about liking or disliking. It's just saying there's more information there that can be mined. There's more tooling, as I think you said. So that's one of the reasons it gets so much of your attention.
It is. And of course, we can go on and on about that, but let's not.
Well, so why don't we use this? I mean, maybe this will get most of the time today, really get into this Athena conversation about is it suppressing price, right? Is Athena responsible for suppressing Ethereum's price and pulling it off the table for a lot of investors who have been saying, oh, it's not going anywhere. And, we're not getting into discussion about, development activities and repos that are getting updated, conversations about developers. We're simply talking about some of the sentiment that you hear. And then, you start to look at some of the fact that Ethereum may be a victim of its own tooling capability from a price perspective, not from a growth perspective where it's being used. But you put out this tweet. I think this really gets into sort of this conversation around supply and demand and flows, because at the end of the day, people want to know about the fundamentals that are going to be driving some of that activity. And they also want to know sort of these outliers that are going to be suppressing the price, because price is top of mind.
This actually is great dovetail into what we were just talking about, because when an asset has kind of more instruments available that are attached to it, it actually ends up suppressing volatility to a degree. And one of the things with Bitcoin, as it starts to kind of move its way into TradFi, and you see, say, like cover call writing strategies where they go ahead and they try to bring to market the ability to go ahead and harvest Bitcoin for yield.
Mm-hmm.
Right. This is the carry trade example as well. Right. And what it does, it suppresses price, because now you have this sort of activity that exists where it's on the sell side that did not exist beforehand. Like 2017 is the time period that, I really like to bring up, because there was not much opportunity for individuals on the sell side. Right? Yeah, you could sell spot. Yes, there was some futures markets that existed where you go ahead and sell it. But on the TradFi side, it's like really you're just buying spot for the most part. Like there is no opportunity to go ahead and harvest any yield. Right? And so that's why you had such a parabolic move in November and the first part of December 2017. Right? You really just kind of had a one-sided market. And I think I want to say it was Giancarlo, I forget who it was, in 2017, but he was like, we're going to tame this monster. I don't think he used monster, but
beast.
Yeah, beast. But that's what he's alluding to, right? We're going to suppress the volatility because individuals want to harvest the yield here. And when we look at Ethereum, we're able to create these instruments on chain, because of this kind of permissionless composable environment. And so now you have Athena show up, and they're almost able to figure out how to do this on a centralized exchange and try to create some level of transparency that exists so that it almost feels a little bit more on chain. And so they have, right? The success is incredible. $6 billion worth of, TVL. Yeah, go ahead.
Yeah. So can you, for the audience that it maybe isn't as familiar with Athena, can you just give a simple explanation for what it is?
Definitely. Yeah. So whenever funding rates get super elevated, and so funding rates is really just in the perpetual futures market, you go ahead and you take a long position. You're going to have to pay for that if the market is sort of neutral, right? And you're paying the individual on the short side. Right. And this is the beauty of perpetual markets. And I know they've existed for a long time, but Arthur Hayes for sure is the one who created all the popularity behind it within crypto. And when you have a ton of individuals taking long positions because it's a bullish environment, that funding rate gets elevated. And what it does is it sort of limits, the ability to hold that long position for an extended period of time, because eventually it's going to force individuals to go ahead and close that position. We can kind of bring this, whoa, sorry about that. I'm moving my hands too much, but we can bring this back to borrowing rates, right? When it gets too expensive to hold a position or kind of open up a new position, right? That's sort of forcing the hand of the market to kind of constrict. Right? That next unit of capital is now asking itself, is this too expensive? And that's what these funding rates do. And so that kind of helps keep things in check. So in a bull market, those funding rates get really high. They get really elevated. And so what was really popular in 2018 was you could just take a 1x short and you're essentially locking in your portfolio in US dollars.
Mm-hmm.
And because the market was still like hopeful that things were going to come back to life, and because the ICO area was still running hot at the time, is that they were able to harvest yield. And that was incredible. And what Athena does is essentially does that for you, and it bundles up that kind of 1x short position in its synthetic stablecoin. It's essentially that funding rate getting packaged into an on-chain asset.
So if I can cut in here, so it's marketed itself, I think. You can correct me if I'm wrong, but I feel like it's marketed itself to the retail investor class as a stable coin using this funding rate mechanism to maintain its peg.
Yeah, I mean it's a financial instrument, and it's you can kind of think of it as a share in that position, right? If you have all these assets in a fund, and they go ahead and issue one share for every dollar that sits within this position, right? That's what they're selling to the market, and they're calling it a stable coin. I don't think that's a fair term, but whatever. That's, I'm not trying to split hairs. If you know what it is, then you know what it is. But I don't think most don't know. Right. That's kind of an issue. They're trying to call it an internet bond, right? But that marketing just sucks. Okay? But that's really what it kind of is, right? It's essentially the ability to package up like the cost of capital, right? The cost of that, ETH position, if you will, and then putting yield on top of it. Internet bond's a great term, and I wish marketing didn't matter so much, but stablecoin sticks.
Which is kind of interesting because Arthur Hayes, I feel like, is kind of light years ahead in terms of marketing. So, but he's not in charge of Athena. I think he's an investor, and I don't have all the details there, so I'm not going to try and go down that hole.
It was his idea, essentially. Like he brought it up a long time ago because he was just saying, like, the funding rate is just it's great. Right? How do you harvest it? How do you create? I think he called it like the Nakamoto dollar or something. I really forget. It's been so long, but he made this term up, and it was really just kind of around Bitcoin because he's a big advocate of Bitcoin.
Yeah, he's
for good reason.
So help me out here. So we have this product, like you said, it's a financial product. Let's put the terms aside. We know that it's harvesting yield off of the funding rate. It has a mechanism to do that. And then, then you have a stable coin that you can use, or, financial stable coin that can use like any other stable coin is used, right? The variety of use cases. So fast forward to, how does that take us into this idea that itself is suppressing Ethereum? Where did this conversation start, and where did your analysis kind of pick up?
Yeah, and I'll also add it's using staked ETH. Right, so it's using a staked ETH holding, and because staked ETH has yield attached to it, right? They're able to kind of collect that yield as well. And on my screen, you can actually, let's see if I can.
Let's see
the yield down here, right? And was around 5% in the first quarter of 2023. 2024 in March, right? That's when things got really kind of heated up and euphoric. We were in the upper 3%, and we've only trended essentially down Right? We're sitting at like 3.3%. That sucks.
Which you have kind of called the risk-free rate. I mean, at times I'm not sure that marketing is kind of caught on, but the Ethereum staked rate is kind of your risk-free rate for the market.
It's one of kind of like those pegs that do exist. I mean, there's the ability to go ahead and with Pendle, for example, you can go ahead and kind of just sell that yield ahead of time. Like if you think 3.3%, and these are these markets up here, like we have in yellow, it's the December 2025 expiry. The red one is already expired of last year. And then you have the blue one, which is end of 2027. So if you want to go ahead and lock in rates until the end of 2027, like go ahead, you can do that right here. Like that's the market for that. So that kind of locks it in. You don't really have much risk except for if you're trying to be US dollar dominant, right? Like your risk is the ETH price movement relative to dollars. So yeah, getting back into it with Athena, they're able to kind of harvest that yield as well as harvest the funding rate yield, package it up into a token, and then make it available on chain. And so what I find interesting for this cycle, and let me pull up that chart because this is kind of like one of the later insights I was trying to hit on that I don't think is fully appreciated. But this chart right here is the amount of ETH assets that exist in these protocols. And I know protocols have kind of come and gone over time, so it's not like the best snapshot that we could possibly make, but this is a good representation of how people were using their ETH on chain over the years, right? And so in 2020, because a lot of people think that DeFi started in 2020, but you did have Maker exist for quite a long period of time, right? Like look at this 2018 growth, no competitors, right? And then you kind of had Compound show up and create this incredible narrative with the yield harvesting token of Comp and that explosion. And of course, SushiSwap followed 2020. But then after that, like look at this explosion of ETH being locked up in all these different protocols. Massive, right? And so that ETH gets locked up and it's being borrowed against, likely using dollars. Well, what are they doing with those dollars? They're probably harvesting yield. They're trying to take some other degenerate positions. Maybe they're buying more ETH, or maybe I think Oregon back in the day was paying salaries doing this method, using their treasury to go ahead and do it. So this is where it was going, right? And there was no short exposure when that ETH got locked up as collateral, right? You weren't locking it up and then the ETH was getting sold, right? Especially when it came to DAI, right? It was just collateral and it was just minting it out of thin air. And so as far as price movements, there was no upside there was no suppression, if you will. And I think suppression is a poor word here because that almost suggests that somebody's being kind of like malicious, but it's just that's the instrument.
So yeah, so let's be very clear on that. You're not seeing any activity, and you could always do more, but there's no activity saying that there's a malicious actor going out there and saying, okay, I'm going to put my thumb on the scale, make sure that Ethereum's price doesn't go up. It's that you now have a variety of instruments that are out there. They're now being used in various ways to harvest yield. And as that yield is being harvested, it is impacting the Ethereum price.
Yes. So like fast forward to today.
Yeah.
You don't see people using these protocols as much. Like look at the growth here. And this is mainnet, right? So we have to take this with a grain of salt because some capital has moved into L2s and done this activity. But you don't see the parabolic trend that you saw in the prior cycles. And that's missing. This parabolic trend is going towards Athena, right? It's got, I think, almost $3 billion worth of Ethereum sitting on its sitting on its protocol. So that's where the market has gone, right? That has won the demand that existed in prior cycles. But now that instrument is now selling kind of that 1x position. And so that didn't exist prior. And so now you have the market signaling that, it really just wants yield. It's just willing to use ETH as collateral. It's not trying to take this speculative position, because when you went ahead and you went on Maker, you used ETH as your collateral, and you still got to maybe borrow at a rate of like 8, 10, 12, 14%. Right? You're still long, right? You're still long because if ETH continues to rise, like you're in terms of like the health of your loan, you're in a great position, and you could borrow more if you want to, right? You're continuing to be long. And as soon as, everything kind of snaps back and reality comes back at you quick, yes, it gets sold, right? And you have heightened volatility as those kind of lending, cascading liquidations take place in the market. You don't have that this time, though, right? Like that's the feature that's going to exist here that we're not going to appreciate until you see bankruptcies show up again, on mainstream media outlets of similar to what we saw with BlockFi and whatnot.
So you gave just to rewind here a little bit. So your argument here is what you're seeing is that the market is really fine chasing or getting some yield. Athena seems to be the place in which they're doing it because they can get this short exposure. Can you walk through what that looks like from an investor standpoint? How exactly they're getting that? I mean, it does because I know you mentioned that Athena is not only getting the funding rate yield, but it's also taking yield from staked ETH. So is it as simple as you deposit your Ethereum with Athena, and then you're able to take something back? Just maybe help the audience with that. So I know I haven't actually used the
you got
protocol.
dollars or you got ETH, and you go ahead, you open up their app, and then you would go ahead and request that position or stablecoin, and they would either go ahead and purchase staked ETH out of the market or swap ETH for staked ETH. And then that moves into a centralized exchange, and then they do a 1x short. So they're essentially selling ETH on the market. In that position, will collect a yield via the funding rate, right? And since they have staked ETH as collateral, they go ahead and get to earn the APY on that as well. And then they pass along that yield to those that go ahead and hold that kind of stablecoin position. I believe you have to stake it. That part, I'm not 100% sure, but how do you redeem the yield? I think you have to stake it, but yeah.
So coming back to the lending rates, because we started this segment talking about those, and those just spiking and the cost of capital going up. It seems to be the sort of bifurcation of these investor or trader classes where some are basically saying, I'm going to lock it up for this sort of stable yield and downside protection. Others saying, no, I'm going to go after and really try and capture more of I would say the upside potential that is out there right now. And that's why capital is going up so high. It's becoming so expensive to actually get the capital. Is that an accurate depiction of what's going on in sort of these two different groups? I mean, they don't necessarily have to be two different groups. You could have someone who's doing multiple strategies, obviously, but I feel like it's two different cohorts, maybe.
I think it's a combination of things. Like the market itself, like we are now in traditional economy in this high rate environment. Like 5% on treasuries is what we were realizing not too long ago. And that was extremely attractive, especially in a bear market. And that was why we saw essentially real world assets, being these protocols packaging up treasuries and trying to make them available on chain. People wanted that. Like that was a product that was in demand. And, now we're not too far removed from that world. And how far has kind of ETH price moved since that environment? Like it hasn't really moved a whole lot. Like you're moving from say 3,000 to 4,000, right? You're just moving 33%. Okay, what's the yield on Athena, right? It's pretty similar or higher upwards of 60%, I think. So if that's your trade-off, like it's not that bad of a trade-off. Like go ahead and use ETH as collateral, harvest that yield. And are you really missing out on the speculative upside of ETH? Historically, you haven't. If anything, you're probably in a better position because you're also getting probably ENA tokens on top of it. So you have some speculative upside exposure. So it's not necessarily that it's like TradFi or on chain. I think it's just what has been, the demand for the market, what has been the behavior of the market. And then are you really missing out on anything if you go ahead and move your ETH into this vehicle? And historically, that hasn't really happened. Will it happen? Possibly, right? I think there has to be some sort of kind of price shift that exists at some supply shock, if you will cause this sort of price shift. Like that still needs to happen. But if Wall Street doesn't show up, where does that demand show up to create that effect? Because right now the current demand is just willing to go ahead and use Athena for the most part. We're not seeing it in lending protocols, right? If anything, we're going to see it, selling for a speculative asset that might exist on Base, for example. Like that's a consumer thing we're seeing right now. Or spending ETH to go ahead and create these AI agents at the moment. But we don't even see the fee market starting to spike up that much. And we're seeing the blob market.
Yeah.
Blob market is a little depressed right now.
Well, so yeah, maybe this is just real speculation rather than just hard analysis. How much do you feel like this is at all sort of going back to decisions made by sort of the Ethereum development group and sort of the environment at large with some of what they've done with fees? Like, is there a scenario in which they could have just made better decision with fees and this, call it suppression or impact on price, would have lessened because you would have seen more demand on L1?
And this gets into the current rhetoric right now against the Ethereum Foundation. And, I kind of sympathize with both sides of this argument. Because yes, they are detached from kind of like what people are building. Like we hear about all these great features coming, but does that really address what the market wants at the moment? Like account abstraction and what's kind of being built out there, is then chain abstraction's coming, and you're not going to have that much developer docs. Like how does that actually like hit the products that people want? We have our answers. That's some of the things we're building. We're using account abstraction. We're looking at chain abstraction. We're looking at all these, this new tooling that does come about. But there are limitations, and you don't hear that discussions happening. And so as far as like where the builders are for what builders think people want to use, and then the distance that exists for the conversations of like what is being considered for the next upgrade, that is a pretty wide gap, right? And the individuals trying to fill that gap would be like a content creator, for example, because I guess like what happened in Ethereum this week is getting shut down. And so you don't have that sort of representation that exists between those two parties. And so I even made a comment, I forget to who, was trying to gain this opinion. Is like, well, what could happen? I'm like, well, you kind of need, like, I hate to say this, but like some sort of lobbying mechanism that exists where like you have these builders and their voices not being heard. So who's out there trying to collect that voice? Like that needs to come from the foundation side. And so if the foundation go ahead and have sort of representatives that maybe exist in the various kind of sectors that are building on Ethereum. Of course, how do you figure that out? That's a different conversation, but you need some sort of representation trying to figure out what's being said. And you don't have that, right? It's very inward looking, and you're having a lot of these debates that exist. And blobs, I think, is like a case in point here. And you're having sort of this fragmentation of like, where does scaling, where is that going to happen? What's going on with the blob market? How do we go ahead and scale over there? But it's like, you guys, the fees in the blob markets are going down, right? It's like the smallest unit as we're speaking. And you want to go ahead and create essentially more room in the network for something that's not existent at the moment. Where's your head at? And so you're going to go ahead. All right, let's open up the lanes of the highway. Okay, but are the cars going to show up? Why would the cars show up? Yeah. And I don't think I hear enough of that question. And one thing that I believe that has gone completely not ignored, but like nobody has mentioned this, is that if you look at fees on the L1 over time, irrespective of the price in dollars, they've gone down. Like, people don't appreciate that, but like in terms of technology, in terms of like code, like things have gotten more efficient on chain. Like if you look at a swap, this is sort of something that we're writing up right now, is yes, it was 21,000 units of gas, but the average cost to do just a simple ETH, not swap, but just transaction, a simple send, has actually gone down because, you have parties that are starting to bundle transactions, and you have all these kind of new tooling that exists that brings that cost down in terms of the amount of gas that is needed in the network. And it's not just ETH simple send. You see that on DEX swaps. You see that in lending, right? Code is getting better and tooling is improving. That's actually bringing costs down.
So I want to get to the heart of this because I think it's almost easy to miss what you're saying. When you have some of the data and you're getting to the specific use case, it's becoming less expensive to use Ethereum L1, and you're not yet seeing some of the congestion concerns actually arise that would come from an L2 or even an L1 direct use that would really give rise to higher fees, right? So they've almost built out the capabilities before the demand has shown up, which in one hand, you could argue that's great. We're ready. Let's start getting the marketing efforts out there and get as many people on here because we're ready to take on that demand. On the other, it feels like maybe it's a chicken and the egg thing. You could have waited until everyone was bursting at the seams saying, hey, we're in pain. You need to change something. It's too expensive. But that hasn't really matured. That hasn't taken place because they've overbuilt capacity.
There's so many ways to slice it, and it's just they're almost expecting a lot of demand. Right. They have this expectation that it's coming, right? There's going to be so much L2 demand that we just, we just need to get ahead of this. And it's like, why? Like, why do you never see the Fed get ahead of anything, right? And people have their comments on that, but it's like, if things are going good, the likelihood it's going to go good tomorrow is higher the longer that happens. So if you make an adjustment, you change that probability right away.
Yeah, I could argue from their perspective if it's this, yes, I see what you're saying. Hey, the Fed doesn't do that. But the Fed also is, I guess the question is the Fed not getting ahead of it because it's limiting foreign investment or it's limiting some kind of economic growth? Here you've got developers that are looking at this and saying, well, we think the reason we're not seeing more demand is because we don't have the capacity. So we just build it out. Right.
You do see that, but it's like, okay, so you want to make, in 2023, when things were like, nobody was on chain doing much, not many people are building, fees were so low that you could build on L1 and you can go ahead and make all these transactions for low cost. Right? If the mentality was to shift to an L2 world, dominant world, and you were trying to make your L1, fully data availability, would you create that environment for individuals to think they can build there. You shouldn't, right? You should not let that anybody kind of dip a toe in the water on the L1 and start setting up shop there. Right? If your main concern is that you want to go ahead and scale via L2s, then you kind of need to change the way that you go ahead and you have fees that exist on an L1 market. Right? They should not be that cheap if it might bring somebody in with this sort of like just false expectation of what it is, and they've built up over the course of 2023 and maybe part of 24, and then now that the fees start to get elevated, they're like, wow, we're subject to this, and this is why I'm able to kind of speak about it from a builder side. It's like things were working great on L1. Liquidity is all there. Fees are so cheap, so liquidity is there, right? And that's where the opportunities sit. It's not going to sit on an L2. So if you're going to go build on an L2 and fees are going to get elevated, great, but your product isn't going to go working over there because everybody has set up shop on an L1 because the fee environment's so low. But now that we kind of saw hints at a high fee environment and we see some people moving into an L2 world, now you got to go ahead and make what you did on L1 work on an L2. And now you're seeing fees come back down, and it's like, well, where the heck am I supposed to set up shop? Right? And there's not enough of that conversation. You want products to set up shop in L2, then move the liquidity to the L2s. These products are going to follow the liquidity, right? If you don't make liquidity accessible on L2 into the L1 environment, okay, then the products aren't going to move over there either. And that gets back to this Ethereum Foundation trying to figure out, like, what do builders want? Why do they build where they're building? I don't think I've ever heard that question, ever. Right? Yeah. And if for anybody that's built financial products, and to all the bad criticism that does exist on the Ethereum Foundation side, where everybody's building tools for financial applications and speculative things and DeFi, etc. Well, I mean, these public blockchains are putting digital assets on chain. Like, what do you think is going to be the biggest use case? It's going to be these financial products because there's so much opportunity that exists. Not until all these opportunities get squashed and those margins get squashed will you see products that, I think some of the, I don't know, I don't want to say too many negative things over there, but like these consumer products that don't really have that much margin, right? Like, why would you spend the time building something like that if the margins aren't there? Or better yet, you have this other product that could be built that could have incredible margins. Like, I think Hyperliquid, there was a product built on Hyperliquid PVP, and they were just making, like, I forget the number they've made in the past 30 days, but you see that and it's like, wow, we should build something like that. Right? Like, okay, maybe not this messenger app because I'm not going to get that much revenue off of that. And, VCs have the same mindset. Where are they going to allocate capital? So where is that conversation taking place where it's like, why do you want to build over here? Why would you not build over there? Okay, what happens if this takes place? Would you build over there or not? And if that does happen, then I think you get a better fee environment that exists on L1. You kind of get the incentives to where they need to be. You get liquidity to where it needs to be, and then you get the builders building around that liquidity, building where they need to be.
A lot of ifs there if you can get there.
It's alignment, right? And you're not good at that. Well, and that's hard.
Well, let's talk about something that could, and I think this brings it back to Athena. This, we talk oftentimes about price being a corrective mechanism, and in many ways for the good, right? Good price can really help to solve this. Maybe not in the cases for everything that we're talking about from Ethereum, but from a price perspective, certainly it could bring back some of the enthusiasm I think that people have for Ethereum, and definitely get away from some of the negative stuff. And I want to bring that back to Athena because, we've talked about how it's really had an impact on the Ethereum's price movement because people are chasing yield. And I think in the thread that you posted on X, you talk about what's going to be the catalyst to kind of break it out of here. And I think you even said just in this conversation, you don't think it's going to be from the existing on-chain environment. You really think it's going to be more Wall Street. Is that correct? And if so, can you expand on it?
Yeah. On-chain demand is, as we mentioned, like where's the incentive to go ahead and move outside of earning 30, 40% yield? Is Ethereum going to go ahead and break out to make, a 2x? Like where's the line where you're willing to risk just full upside exposure to ETH versus, being happy with what the yield that Athena is offering? Like, I don't think we're there. Right.
Mm-hmm.
So on an on-chain world, when it comes to what does a consumer want, or what is an investor, willing to go ahead and accept versus accepting the possibility that ETH has great upside. Right? I don't think we're going to be crossing that anytime soon. And I don't think we're actually going to cross that chasm this cycle, where the on-chain environment and world and population, if you will, is not going to seek out ETH. So that has to come from somewhere else, right? Otherwise, we're just kind of going to be sitting in this really vol suppression world because of the product that Athena has built that people really want to use.
Mm-hmm.
And it has crushed it so far. So it has to come from somewhere else. And ETFs are a product where they can't really get that Athena exposure, right? They can't take their ETH shares and lock it up to earn a yield as of yet. And so if we go ahead and we look at, where can the demand come from, that is the location where we need to keep both eyes, well focused to see when it starts to spike up. And if it does, and again, this is a big if, and I don't follow it enough to have a good take there, but if it does show up, it will expose the current shift of where available ETH is, which has been declining. All right. It's not sitting in lending protocols, which was the chart that we were looking at before. And we know there's a lot of ETH moving into Athena. There's also a lot of ETH just simply being staked to the beacon chain that I think kind of goes unnoticed for a bit. Then you also have a lot of ETH that's sitting in kind of these liquid restaking tokens, and some of those are getting locked up in various locations across crypto, right? And so what this is doing is you have a massive bucket sitting kind of in this 1x ETH short. Right? Those are actual units of ETH moving into that trade, right? That is not supply that's available that can be traded. Mm-hmm. And so if anybody remembers, we call this M2 supply. Right. This is not liquid tokens in the market. Same with ETH being locked to beacon chain without that liquid staking token derivative off of it. Right. It's not, in order to make it liquid, you have to unstake it. You have to wait a little period, and then you can finally sell it in the market. Right. So it's not fully liquid like a token just sitting in your wallet. Staked ETH, if you hold staked ETH in your wallet, I know it's, there's an underlying unit of ETH being staked, but it's fully liquid. You can sell it tomorrow, right? So if we ignore Athena for a moment and we just look at the supply that is moving into this illiquid environment, and that's what this chart is right up here, it's sort of a ratio of M2 to M0, or M0 plus another one called M1. But all you need to know is illiquid versus liquid. When this kind of green and yellow start to climb higher, that means the supply at large, in terms of like a percentage, it's getting more and more illiquid. Right? And we can see it has this correlation to price. When things get very illiquid, price is able to respond in this manner where it just goes parabolic. Right? And we don't see this sort of parabolic trend that we saw at the end of 2020. We're seeing a slow march higher. And that's what we see right here, right? We see the slow march, and then bam, price responds. And because prices move so much, individuals are willing to unlock because prices move so much that they're now becoming sellers. That's that behavioral attribute talked about earlier. So then you have that sort of that lull that takes place, and then you kind of see the activity like, okay, I'm willing to go ahead and start moving in this illiquid environment. And we've been marching higher since April 2024. We're coming up on a year soon. And so if we're kind of marching higher and ETH continues to move in this illiquid environment, and then you have what's happening on Athena as well, and that ETH is being removed as well, what we actually don't see in this chart is the Athena portion. And so that yellow and green line is actually moving even higher than it has ever. I would have to imagine if we were to include that data in this, it's hitting levels that we did not see in 2021, which is telling me ETH as a whole, supply at large, is more illiquid than it ever has been.
So it's really just waiting for the right catalyst to expose this illiquidity.
And it's not going to happen from the current users of ETH in the current market, right? It has to come from somewhere else. And so if we think about what could happen, we're looking at a taste of it right here. Like when the environment, in terms of like how liquid or illiquid ETH is moving to an illiquid environment, any sort of demand catalyst creates these big upside movements. But the only way that we can truly get it is going to be if fresh demand shows up. Because if it happens in this on-chain world, we don't see ETF buyers coming in. We don't see a new class of retail coming in because they're not going to want an asset that's $4,000 per token. So it has to come from somewhere, because if it comes just from within the own on-chain kind of crypto natives, we already know what they're going to do. They're going to go ahead and harvest the yield, put in that 1x short, and we're kind of where we are. Like, we're not going anywhere new. We're just using ETH essentially as this form of collateral, which is essentially this store of value, if you will, to go ahead and earn this yield. But if the demand shows up from an ETF's side, it is fresh demand, it will expose how illiquid ETH has become over the past year and a half.
Very interesting story for sure. What would you say, everything's in probabilities, right? For what this can look like. I think the expectation at this point is everyone's expecting a very, if they had to put a number on it, 50%, probably 80% that 2025 is going to be a very bullish year. What would you put the percentage likelihood that the ETFs expose this illiquidity in a very meaningful way? That the ETFs get sizable. I mean, if I just looked at the numbers, I think I showed them at the top of the broadcast. But just to recap, I think we had one outflow of about 77 million. Then we had basically 59 million, and then one day of 128 million, which is near the top outside of the investment. There you go. If we look at Ethereum, but just for this year, definitely some good flows. But what would you say is the likelihood that we see that sort of exposure happening from the ETFs?
110%.
So you're that confident?
If Trump is talking about a Bitcoin strategic reserve, and he's going to go ahead and take the oath of office, and you see essentially every appointee, every future regulator, all of his cabinet members, they're all either having exposure to the cryptocurrency industry, either by owning Bitcoin or having exposure in ETH. Why would it not be a great 2025 when it comes to innovation and even iterating on various products that have existed in the market for some time? I don't see any reason why either, maybe not Uniswap, because they probably have some other politics that many don't know, but Aave has hinted at it. Athena has hinted at it. All these different products are going to be able to create this new value accrual that hasn't existed before. Okay, you're going to see developer mindshare start to grow. And if if everybody that has been talking on the regulatory side of things and the new administration that's coming in about trying to be pro crypto, pro innovation, and trying to encourage development, where is that development going to sit? On what chain? Yes, it's going to sit on Solana for sure. Right, but at large, like this is going to be, Ethereum has the most developers on it than any other L1.
Mm-hmm.
And so why would it not enter the discussion? You're seeing all these different coins that are essentially dinosaurs that have billions in market cap start to, 2, 3x. And we're wondering if if we're wondering if Ethereum could go ahead and have a similar type of move. To me, it's just like we're kind of missing the forest here.
Mm-hmm.
Like we're missing the whole fact that there's going to be a ton of innovation that's going to be coming. Where is this innovation going to happen? Where can it happen? Can it happen in existing products? And the answer is yes. And of course, one of the places will be an ecosystem that has a ton of protocols being built on it, has a ton of developer mindshare already. And so you change some of the incentive mechanisms that already exist, and all of a sudden you have the TradFi world saying, wow, this protocol earned $330 million in fees. And it was passed on to token holders. What does that price to sale ratio look like? And I know I hate price to sale ratio, but it actually works in that sort of situation. So you go ahead and you have all this revenue. It's not, and then they take a step back and they're saying, oh, that money's being passed to the token holders. Wait a minute, that's not price to sale, that's price to earnings. And that price to earnings ratio is only what? Okay. What could this be worth? Right? That conversation doesn't exist at the moment. And as soon as it does, then the next reason is like, how is that possible? How can the price to earnings ratio be what it is? And then someone's like, well, it just runs on smart contracts. There's no middlemen.
Mm-hmm.
What do you mean? How does that happen? And then, okay, now we have this new conversation that exists that never has happened. And it can't happen on Bitcoin, right? So this conversation, because we're talking on the TradFi level here, is happening talking about Ethereum's unique selling point. So you're having this conversation of these other assets as well. And it's like, okay, well, now you're just realizing what makes kind of this Ethereum asset so unique is it has all these technical capabilities to go ahead, reduce margins, reduce middlemen, bring more revenue to the token holders, right? And you can see the fees, you can see what's happening. It's like, okay, this has this brand new perspective on cryptocurrencies and the digital asset space. How are you going to gain exposure? It is all of a sudden, that conversation of what is Ethereum has this whole new light to it. And it allows people to be able to sell it to new demand, to new buyers, new portfolios. And that right there, that conversation is going to happen, right? You'd see, a little spark here on January 3rd, January 6th, like great. That's nowhere where it can be. It is nowhere where it can be in terms of this thing could absolutely launch. And I think a lot of individuals have written it off. And I think the reason it's been written off is because the current potential demand that could exist for ETH sits within a crypto native environment. And there has been no reason to take the upside bet on Ethereum price when your next opportunity is to harvest that yield. Right? Why would you take on the risk? But when you look at what could be in terms of a demand perspective that doesn't exist right now, if that demand shows up, it's off to the races. And the whole market is too. Let's remember that. The current AI agent narrative that exists, like we haven't even gotten into the infrastructure place, right? We're just sitting essentially on like the tip of the iceberg, right? So if you have this Ethereum layer 1 and even its layer 2 environment start to garner mind share of what is possible over there, and then you have its price start to rise, catch eyeballs because the best marketing is number go up. Where do they look next? What is that next step down the risk curve? And they look at what's hot in terms of the narrative. You find the AI agent narrative, and it can touch everything. And I don't think the market appreciates how this AI agent narrative can actually expand, right? It can touch DPEN, right? It can touch the L2 narrative. It can touch the ZK narrative. It is not just sitting on an AI agent that's talking to you on Twitter. And I haven't heard enough of that dialogue yet. I haven't, which tells me, not only if he starts to run, AI agent narrative is going to run even hotter, right? And we can touch many of the assets that have laid dormant up to now.
Mm-hmm. Sets up for a very interesting 2012. There's so much to unpack there. I think, Ben, I know we have other tokens to talk the flow report. I think today we should just stick with Ethereum. We've covered up. I think we've been on the show for over 2 hours already, and we've covered so much ground here. So I do want to stick with Ethereum. I think you just made the case for Ethereum, what it could look like in 2025. Is there anything else you'd want to share for Ethereum today?
There really isn't.
Okay.
Fees, but actually, there is something. So fees are not great at the moment. We talk about the supply side. We've been hitting on that quite a bit with Athena. We've been hitting it on that M2 ratio metric, and we're even seeing some flows happen on far side. But as far as the demand side, in terms of like the actual chain, we don't really see much happening. We don't see much on the L2s. That market just got crushed the past few days. It is now super cheap to go ahead and be on an L2. And we need to see that activity start to pick up. Part of it is because, again, the borrowing rates are so elevated that it's just the opportunities aren't there. So we have to have that bit of a pullback. We got to have that reset. And then once we kind of have that healthy period where everything does get that reset, you see fees start to have a little bit more momentum than we did. I feel like we saw like an early little spark, but much more is to come. And number go up's the best recipe. So it's as Amit and Benjamin were saying earlier, it's kind of a wait and see on Ethereum. Its price sucks right now. The fees are really reflective of that. So we need to see that start to pick up, and then you can get excited about it. But as far as trading right now on a short-term basis, it's just a wait and see.
Okay. Wow. Well, Ben, this has been just an incredible amount of information. I think just going through everything that we just unpacked, there's going to be a lot that we're going to want to unpack over the next months as we get into 2025. I know I'm very bullish on this year for all the reasons you talked about. I think there's the narratives around AI agents, how the market starts to move, maybe shifting out of really going after some of those yields and looking for more of that price discovery opportunities is going to be an interesting one as well. And then obviously to be tracking the ETF. So let's see how that comes. Obviously, when we come back next week, we can put a little bit more attention on Bitcoin and Solana, see how that's starting to fare, especially if we see a little bit of a contraction this week and next. With that, we'll wrap up today's show. I want to thank everyone for tuning out here. Let us know in the comments. You can leave it here on the video when we post it, replay on YouTube, or if you're on Twitter or X. I think everyone still misnames it. Let us know in the comments what you're thinking. Yes, we are working on mics. Technical stuff is always kind of something we're working on, and apologies for all that. But more from a content perspective, if you've got questions or ideas, let us know. We'd love to hear them. It's new year, but the same PSA. Have some dry powder. There's always new opportunities, and you want to be around for them. With that, this is Marconi White signing off.